Think California still the golden state for homebuyers? Not in 2025. Sure, the views are still legendary, but behind those beaches, freeways, and endless sunshine lies a housing market under serious pressure. Skyrocketing prices, insurance hikes, and affordability so bad even high earners feel squeezed. Today, we're counting down the 10 worst cities to buy a home in California this year. Whether you're a buyer, seller, or investor, this list could save you from making a six-figure mistake. Let's get into it. Number 10. Los Angeles. For decades, LA sold a dream. Hollywood lights, ocean views, and reinvention on every corner. The problem is, that dream now costs almost $900,000. The median home price hit about $870,000 this year, while the average household income is barely one-tenth of that. Even with a solid down payment, many new buyers are looking at monthly mortgage payments above $4,000. That's before property taxes, insurance, or the occasional parking ticket that costs as much as lunch for two. Add in interest rates hovering around 7% and insurance premiums doubling in wildfire zones, and it's no wonder more than 30,000 people have left Los Angeles since 2023. Even high-demand neighborhoods like Echo Park and West Hollywood are showing cracks, longer listing times, deeper price cuts, and investors pulling back. LA still has the glitz, but for most, the math just doesn't work anymore. Number 9. Oakland. Oakland used to be the Bay Area's affordable, creative alternative to San Francisco. Not anymore. The typical home now sells for over $720,000, while local incomes hover around $80,000. That mismatch means buyers are overextending and sellers are slashing. Nearly a third of listings dropped their prices early this year, and homes that once sold within weeks are now lingering for months. But it's not just affordability. Oakland also ranks among the top 5 cities nationally for property crime. Car thefts, break-ins, and rising insurance costs are pushing more residents out, with about 12,000 leaving since 2023. And those staying? Many are paying 40 to 50% more for homeowners insurance compared to just a few years ago. Oakland still has edge and culture, but the stability that drew buyers a decade ago is eroding fast.
Number 8. Stockton. Stockton's story has always been one of survival. After rebounding from the foreclosure crisis, it looked like a hidden gem for families priced out of the Bay Area. Fast forward to 2025, and that momentum is fading. Homes cost roughly $480,000, while the average household earns about $66,000. That stretch has created a fragile balance. Nearly 30% of sellers cut prices in the past quarter, while foreclosure filings are up 17% year over year. The pressure is coming from all fronts: rising crime, higher interest rates, inflation, and the simple reality that local wages haven't kept up. Adjustable rate mortgages resetting this year are also shaking households that locked in during lower rate years. Stockton's housing market isn't collapsing, it's straining, and that's often what happens right before cracks spread. Number 7. San Diego. It looks like paradise. Beaches, craft beer, mild weather, and surf breaks for days. But for home buyers, San Diego's paradise has a price tag that's hard to justify. The median home price here just passed $850,000 compared to a median income near $82,000. That's one of the biggest affordability gaps in the United States. Many residents now spend more than 40% of their income just on housing. Insurance premiums have jumped by more than 50% since 2020, driven by wildfire risk, coastal erosion, and flooding from rising sea levels. Some major carriers have stopped writing new policies altogether in certain zip codes. And it's not only homeowners who feel the strain. Property taxes climb with values and rents remain sky high. Growth is slowing, and population movement, once sharply positive, is flattening. San Diego still looks flawless on Instagram, but financially, it's far from picture perfect. Number 6. Burbank. Home to studios, palm trees, and sunshine, Burbank has long been one of Los Angeles County's most desirable suburbs. But in 2025, affordability and job security are evaporating faster than the winter rain. The median home price now exceeds $1 million, but average income is under $90,000. That gap means even two-income households struggle to qualify. When interest rates locked near 7%, affordability sank even further. Homeownership costs, mortgage, insurance, and property taxes can easily run above $4,500 a month. That's not for luxury mansions, but for average three-bedroom homes. Meanwhile, local job markets tied to entertainment and tech are tightening. Studios are downsizing, streaming services are cutting budgets, and wage growth hasn't kept pace. Listings that used to spark bidding wars now sit for months, often with price cuts of 10% or more. Burbank may look golden, but the housing market feels more like a warning sign.
Number 5. Santa Cruz. Once a laid-back beach haven, Santa Cruz has turned into one of California's most unaffordable coastal markets. Median home values hover around $1.2 million, while local incomes struggle to break $85,000. It's not hard to see the problem. Homeowners here spend more than half their income just to stay current on their mortgage. Add in utilities, property taxes, and rising insurance premiums, some up 40% since 2022, and the math becomes impossible. The city also faces major environmental headwinds. Flooding, erosion, and increased wildfire risk add more cost and uncertainty. Over a quarter of listings have seen price cuts this year, and younger families are leaving in droves for inland cities where their money goes further. The lifestyle is unbeatable. The cost of entry isn't. Number 4. Santa Barbara. Think Mediterranean charm meets California luxury, and then triple the price. In 2025, Santa Barbara's median home price is about $1.5 million, with average local income sitting near $90,000. The affordability index here is one of the lowest in the state. The market has slowed dramatically. Time on market is up 60% year over year, and nearly one-third of listings have cut their asking price. Still, the deeper problem isn't demand, it's risk. Wildfires, drought, and mudslides are all driving insurance premiums through the roof. Homeowners are now paying $5,000 to $6,000 annually just to protect their properties if they can find coverage at all. Sandwiched between rising costs and environmental volatility, Santa Barbara is struggling to balance its beauty with sustainability. It's paradise, but paradise under pressure. Number 3. Palm Springs. Welcome to the desert dream that's overheating in every way possible. Palm Springs saw a real estate boom during the pandemic as remote workers fled cities for sunshine and space. But as interest rates rose and the economy cooled, the cracks started to show. The median home price sits around $675,000, while the median income stagnates near $70,000. Overbuilding and speculation have flooded the market with listings, and about a third have already dropped in price this year. Then there's the climate, literally. Last year brought over 60 days above 110 degrees. Energy bills have soared, insurance costs ballooned by nearly 50%, and drought-related limitations make maintenance costly. The market isn't collapsing, but investors and retirees are rethinking their stakes. In 2025, Palm Springs is no longer a safe bet. It's a hot one in all the wrong ways.
Number 2. Mendocino. Where redwoods meet cliffs, Mendocino offers unmatched beauty and isolation. But that isolation is becoming a liability. Average home prices hover just above $650,000, but the median income is barely $60,000. That gap leaves most locals priced out, while former remote workers are now leaving due to limited infrastructure, healthcare access, and unreliable utilities. Insurance costs hover near $4,700 per year and are rising fast, especially for properties near forested zones. Power outages, narrow roads, and spotty connectivity only complicate ownership further. Roughly 35% of listed homes have seen price cuts this year, the highest rate in Northern California. Mendocino remains stunning, but for those looking at financial stability, it's a tough sell. Number 1. San Francisco. The city that once symbolized innovation and wealth now faces a serious housing hangover. Home prices still average $1.35 million, but demand has cratered. Over 50,000 residents have left since 2021, tech workers, families, and investors alike. Remote work, layoffs, and declining office space demand have thinned out the city's core. Nearly 1 in 3 listings has cut its price, and luxury condos are sitting unsold for months. So why is San Francisco struggling despite its reputation? Costs. Property taxes, HOAs that exceed $1,800 per month, and insurance bills nearing $6,000 a year. Add persistent concerns around crime, cleanliness, and infrastructure, and many potential buyers are choosing to live and invest somewhere else. The Golden Gate is still beautiful, but in 2025, buying here feels like balancing on it. California remains one of the most desirable places on earth to live, but that doesn't mean it's affordable or smart to buy everywhere. From Los Angeles to San Francisco, the housing market is showing clear signs of strain. So what's the takeaway? California's appeal is still real, but its affordability crisis is equally real. If you're buying here this year, you're not chasing a dream, you're navigating a market that demands strategy, patience, and more research than a college thesis. If this list helped you dodge a bad deal, hit like. Want more straight-shooting breakdowns and data-driven insights? Subscribe to Housing IQ. We find the signal in the noise so you can make smarter housing decisions. And tell us in the comments, if you had the money to buy anywhere in California right now, where would it be? Or are you taking your down payment somewhere more affordable? Drop your answer below. We're tracking where real buyers are actually moving next. In this market, knowledge doesn't just save money, it saves futures.